Hello and welcome to Chapter 11, the Statement of Cash Flows. In this particular chapter, we're looking at the fourth financial statement. As you recall, when we went through the beginning part of our text, we looked at three financial statements. We looked at the income statement, the statement of retained earnings, and the balance sheet. The final financial statement we're going to look at is the statement of cash flows. And it's statutory, it's required by the Securities and Exchange Commission to look at the statement of cash flows. Some might argue that the statement of cash flows is the most important statement that there is in the business because it gives us a picture about how a business generated cash and what their ability is to pay dividends if we're an investor or to pay their the interest on their note or their ability to pay back and how they're generating cash as well as what they're doing with the cash they've generated. So the learning objectives for this chapter, we're going to explain the purpose of the statement of cash flows. We're going to look at different business activities of the statement of cash flows. We'll look at the relationship between changes in cash and the balance sheet. And we're going to generate three different sections of the statement of cash flows. That's number 4, 5, and 6. That's operating, investing, and financing. And we're going to look at any information. We're going to analyze some information in the statement of cash flows. What's the role of the statement of cash flows? As we touched on this earlier, it's the ability. One of the biggest things is you want to look at it to see if the company can produce future net cash flows. For example, if you look at a business's statement of cash flows and all of their cash is coming from selling off assets, things that they're productive assets, say trucks or equipment or buildings or any of those kind of things, and nothing is coming from the core business. Let's say they're a retailer, they're a small hardware store or something like that, and they've had all this extra assets. And if you look at the operating section, which is really driven by net income, and we'll get into this here shortly, then we have a problem because long term the business cannot survive and they cannot generate cash based off of their core income and their core responsibilities and what they're responsible for. And we want to understand the difference between cash payments and cash receipts. Look at how if the company's going to need external financing, and look at the effects of the statement of cash flows for investing for non-cash, for both cash and non-cash investing and financing activities. We need to have a clear understanding. To understand the statement of cash flows, we need to understand what is really determined by cash. And cash is really cash and cash equivalents, coins and cash equivalents, money market funds, all these things that are going to convert to cash within 3 months or less are really cash and cash equivalents for the purposes of a statement of cash flows. And really, if you remember the term liquidity, I don't know if we've talked about it, but liquidity is how quickly a asset can convert to cash. The more liquid it is, the faster it's going to convert to cash. So accounts receivable typically is going to convert to cash fairly quickly within, say, 30 days, typically, or less. That's going to be much more liquid than, say, equipment because it's going to be much more difficult to sell equipment and convert it into cash. And we're looking at accounting terms, and we're going to look at three different business activities: operating activities, investing activities, and financing activities. And they each have a cash inflow or a source of cash and a cash outflow or a use of cash. In some accounting texts, you'll see it as source and use as opposed to inflow and outflow. So if you're looking at some other place, that might be another term if you're more comfortable with that, just a source and a use of cash. And so here's the links that we have, and this is just a little bit of a little bit of a not a review, but if you take a look, the first thing I want you to highlight is what the statement of cash flows is. It bridges the cash from one year, 2011. If you look in the upper left, December 31st, 2011, to December 31st, 2012. So you're looking at the beginning cash and the ending cash, and the number I really want you to focus in on is this $600. And we'll get into more detail as well about how each one of these sections work, the operating, investing, and financing sections. But each one of these sections are part of the statement of cash flows. And we'll talk about those. But you notice the thing here is we have a net change in cash, and that would be a positive or source of cash of $600. We had a beginning cash of $1,800, which starts over here, and we end up with an ending cash of $2,400. So really what you're kind of doing in a way is you're doing a reconciliation of these items down to this number and showing what drove the difference in cash year over year from the end of 2011 to the end of 2012 in this particular instance. And remember, the end of 2011 is really the beginning of 2012. So cash flow from operating activities. And what we're really talking about here is things that they do to run their core business. And it doesn't really say this in this particular slide, but there's a couple things you want to start off with, and we'll touch on these in a little bit more detail. The first thing you're going to see in operating activities is you're going to start off with a net income or a net loss. And what we're really doing with this statement of cash flow is, you remember, we're talking about, there's two different methods. We haven't touched on this yet, but we're talking specifically about the indirect method. And what we're doing is we're doing a reconciliation from an accrual based income statement and balance sheet to cash basis. That's really kind of what we're doing here. And we have cash inflows, which are sales to customers, collections on accounts receivable from sales to customers, cash dividends received. So that's on an investment that the business has made, and interest that's received for investments. In the bottom half, sale of goods and services, wages for supply for salaries, and taxes, etc., and interest for lenders, debt for lenders. But the one thing I want you to pay real close attention to, and we'll touch on this as we get further along, in the statement of cash flows and operating activity, what we're going to look at predominantly is changes in current assets and current liabilities. Those changes are going to be reflected in the statement of cash flows. Let's just talk about one, for example, so that you kind of get an illustration. With the exception of cash, let's talk about accounts receivable. We'll talk about both accounts receivable and accounts payable. Accounts receivable, if accounts receivable went up, let's say the business had $12,000 in accounts receivable at the end of 2011, and it had 20,000 in accounts receivable in 2012. In effect, that is a use of cash. They're tying $8,000 more up, the difference between the 12 and the 20, in accounts receivable. So the business, that's going to be a negative on the statement of cash flows because that is a use of cash. Conversely, if we talk about accounts payable, a liability, if we use the same numbers, if we said accounts payable went from 12,000 to 20,000, in effect, what you're really doing is borrowing $8,000 from your suppliers, businesses that send you supplies and raw materials and that sort of stuff, or it could be utilities or anything. But you have now had an increase or a source of cash because you're in effect borrowing money from them in the short term. And that's just one way to look at the statement in operating activities. The next one is investing. And if you really want to think about investing, you can read through all this stuff, but let me give it to you in a nutshell. Investing really says, how are you going to invest in your business? You're either going to invest, let's say you're a moving company. You could invest in buying a new moving truck, buying a new warehouse. Those are going to be cash uses or cash out, and that's a minus. And then you can look at if you sell something, let's say you're a moving company, you sold a piece of land that you had that was adjoining your moving warehouse, or your warehouse. That could be a source of cash. So that's really the kind of the big things here. And if you look at it, it's really changes in long-term assets predominantly here. It's changes in long-term assets, property, plant, and equipment, notes receivable, or the sale of investments in other companies. Those are all going to be investing activities. They're not operating activities, because the operating activities is really kind of day-to-day stuff, and the investing stuff, it focuses more on the long term, not on the short term. The next one is going to be financing. And financing predominantly revolves around three things: stocks, bonds, and dividends. And bonds are notes payable. So what you're talking about here is, how are you paying for the assets that you purchased? How are you financing your business for operations? So the issuance of common stock would obviously be a source of cash, because you're going to debit cash and you're going to credit common stock. So that's a source of cash. A use of cash might be paying dividends to your investors, and also taking out a loan, or buying bonds, a long-term loan or notes payable, or buying bonds. Those are also going to be financing activities. But if you look at it, it's really the long-term liability section and equity section of the balance sheet that you're looking at here to determine how you're financing the activities of a business. You also have something called non-cash investing and financing activities. These are things where maybe you did a 100% loan to buy that moving truck we talked about earlier, or you might exchange one asset for another. Typically, that's going to be a barter, and they're non-cash activities, and they're reported on the statement of cash flows, but they're reported as a note. They're not reported as a they're not reported in the in and out, because if you did, you would have two line items, one for each. And so you want to report those as a separate and distinct line item in a supplemental schedule, because it still is important to know, but you don't need to report those in the statement of cash flows in the line items in the operating, investing, and financing sections at all. So here's kind of a quick summary, and you can read through all this stuff. But really, I think the biggest thing I want you to know is you have sources and uses, and you have operating, investing, and financing activities are the things that you're going to have in the statement of cash flows. And predominantly, what you're going to do for the operating and investing section, and almost all of it, is you're going to look at the net change in the statement. They're looking at changes over year to determine what has changed in each one of these broad categories. And we'll talk about that. Let's go to the next slide and let's spend some time. So I'm not going to read through all this stuff, but it's going to allow you to classify business activities. And these are all different activities that you want to look at, um, and determine if they where they would go on the statement of cash flows. And what I'm going to do, and you notice it says you want to classify these as operating, investing, and financing. And then it says here cash receipt or cash payment. I would say a source of cash would be a cash receipt, or a cash payment would be a use of cash. And I'm not going to spend more time. I'm going to leave this slide. You might want to pause the lecture here for a few minutes and go through some of these, or go back and forth. But these are the answers that you want to take a look at as we go. Here's the format of the statement of cash flows, and this is Brooks Sportswear, and this is for 2011. And you have broad categories. Here's the operating. So here's the three sections: operating, investing, and financing. Remember, there's a couple things that are in here that don't show. You start off with net income. Then you have two other line items that we'll see here in a minute, but I'm going to touch on them. And that has to do with the sale of a long-term, the gain or loss on the sale of a long-term asset. That needs to go in here. And also, and we'll touch on how that works here shortly. And then the second thing that goes in here is depreciation, because depreciation is a non-cash expense. You might also have amortization. You have to add both of those non-cash expenses back in this section. And then down here in the investing section, whatever cash you got, not the gain or loss on the sale of a long-term asset. So what you want to do is add back a loss and subtract the gain. Remember, I'll say that again: add back a loss and subtract a gain, and look at the cash. You're going to have to go look at how much cash was generated. And whatever cash was generated is going to have to go in this investing section. Cash from sale of equipment, not the gain or loss, but the cash. You go down here in the financing activities: long-term debt, long-term long-term common stock. So this is the bottom half of the balance sheet on the bonds and the equity and debt side, long term. This is going to be really long-term assets, if you will, changes in long-term assets, and this is going to be changes in long-term and current liabilities, plus net income and depreciation. And what this says here is you need more stuff than just the balance sheet and the income statement uh, to create a statement of cash flows. You need multiple things. You need an adjusted trial balance, and you need some other things. Because what we're doing, as we talked about, is you're going from an accrual basis to a cash basis, because we don't, so we want to try and figure out why cash changed. You can look at some of these formulas, and you might pause it here, but I'm not going to go through these. But really, same thing: sources of cash. Increase your liability, increase your stockholders' equity, and decrease in non-cash assets. And the same thing down here, it's just the reverse. So here you can take a look. Here's another concept thing we'll look at. And we're looking at it between 2011, the beginning of the year and the end of the year. So for example, let's look at this top one. Accounts receivable went down $7,000. So that means really even though this is a minus here, it's a source of cash on your balance sheet, or in your statement of cash flows, because it would be an add, because you had $7,000 more that came in from your customers. So that's going to be a source of cash. Bonds payable is the reverse. Because remember, this one's an asset, this one's a liability. They went down. So that means you've paid off money. Imagine if this was your home mortgage and you owed 400 and now you owe 300. You had to pay it off with cash in some form or fashion. I think you can read through the rest of these and see what's going to happen for each one of them. This the retained change in retained earnings is also going to be a source of cash, and the unearned revenue is going to be a source of cash as well because you're basically borrowing money from somebody else. So you can kind of look at these and classify these before you even start and say asset, liability, asset, asset, equity, equity, liability, liability, and the nature of them will drive where they need to be on the balance sheet and or where they need to be on the statement of cash flow. So here you go. And you can look at the solution. You can pause the lecture here and look at this, but that's what you have. And so here's a summary again. So this is kind of along the same lines as what we had before. And you can see here, now we're talking more about currents and currents and the same thing here. And I don't like that they have these retained earnings in here at all because really what you're dealing with is net income. Net income. So these two I think are a misnomer. You don't really want to look at the retained earnings. You're going to start off with the net income and adjust it for a couple of things. So even though they have those here, I don't think it's a very good comparison and it's difficult for you to understand. So I would suggest that you ignore these two pieces and move on from that. And don't worry about that because you're going to pick up the net income. You're going to pick up the dividends down here. That will be a change in the retained earnings. And you're going to pick up the changes, the gain or loss on the sale of a long-term asset, which they don't have in here either. Because you'd also have in here cash from the sale of a long-term asset. So that's another one that you're missing. But I want to just spend just a minute here with this. So what do we need? We need comparative balance sheets. We need the stockholders' equity section of the balance sheet. We want to look at to determine we want to lose current income statement to determine the cash flows from operations. And we want to look at some other stuff as well. So we're going to start with 5 basic steps. We're going to do it. And really what we're doing, operating, investing, financing, adding them all up and comparing them for the cash in the period. That's really the biggest steps here. So let's start with operating. We can use both the direct and the indirect method. And the direct method, it's next to impossible to find the direct method unless you go look at the SEC website. And they're probably the only organization that does the direct method on the statement of cash flows. Everybody else, for the most part, that you're going to find is doing the indirect method. And it's much easier to do the indirect method than it is to do the direct method. That's why it is done that way. So we're going to focus in on doing the indirect method for what we're going to do. And we're trying to eliminate. So here's the stuff we're talking about on the bottom on the indirect method. Eliminate income that does not affect cash, such as depreciation and gains or losses on sales of assets. So that's the thing that I've been touching on multiple times in our discussion, that this is the first time they show it in these slides, and I think it's not a really good thing for you if you're trying to learn this. But that's what you need to know here. So what we're doing, we're going to add to net income any non-cash expense and subtract any non-cash revenues. So we're adding any non-cash expenses. Read that as depreciation and amortization, even though it doesn't say it. And really, we don't have a whole lot of non-cash revenues at all. But we also got to take a look at, this is current assets and current liabilities. These other ones, these non-cash revenues and losses and all that stuff. This loss here is this is the one where it has to do with long-term assets. If you have a sale of a long-term asset, and it says add to net income any losses. So you're adding back the losses and subtract from net income any gains. And then it just decreases, increases, and decreases in current assets and current liabilities. That's all that is from here. So here's the Brooks Sportswear balance sheet and income statement. First thing I want you to know, let's look at this first. It looks like we're going from 2010 to 2011. We had a net increase in cash of $2,000. So that's what we're trying to balance to, okay? And if you look here, if we're doing the operating section, we're dealing with just these first from here to here, just the current numbers overall. And it's $20,000 difference. But we're going to do these by categories. And we're going to ignore this top one. But when we look at the operating section, we're going to look at the next three, and then we're also going to do the same thing for current liabilities down here. Now, if we go to if we go to the income statement, there's a couple of numbers we need to pick off here. We need to pick off this 39,000. We need to pick up because we need to know the total. And then we need to look at depreciation, which is 40,000. We want to add that back. And then we also want to look at the disposal of we want to add back this disposal. Okay. And we have this gain as well. So we're going to have to look at a couple of those things when we do our operating section. So those are numbers that we're going to look at. So let's look at the operating section, and let's look at what we have for this company. This is for Brook. There's no header on here, which there typically would be a header. And this is actually cash flow from operating activities. And so we start off with net income. You add back to that depreciation expense. You add back to that the loss on the sale of equipment. Subtract to it the gain on the sale of long-term investments. And then the rest of these are all just changes in current assets and current liabilities. Okay, your current asset, current asset, current asset, current liability, current liability, current liability, and current liability. So this business had cash flow provided from operating activities, Brooks, of $47,000. And you say, is that good or is it bad? That says within their core business, they're generating positive cash of $47,000. I don't know the scale and the size of the business, but that would say anytime this is a positive number, that's a good thing. So, so this is kind of a little bit of a summary. Operating activities under the indirect method, same kind of stuff we've been talking about. You might want to pause this and look at it, but you notice current assets, current liabilities, gains and losses, non-cash and non-cash. Now we're going to look at investing section. The investing section, and the investing section is really how the business invests in their assets and what they're doing with their assets. And it really has to do with long-term assets plus any cash generated from the sale of long-term assets. So that's why when you look at the sale of investments and also the sale of, I think it was equipment on the last slide, those things are going to come back to bear in this next section. So here's what we had. Cash from the sale of equipment. Remember, we added back the loss, but it's the cash that they got. They purchased equipment, so that means that they spent money to grow their business. That's a good thing. Cash from sale of investments, 31. So they liquidated some stuff, but they turned around and rebought some other stuff. And you can almost guess from here, not exactly, the numbers don't line up exactly, but they're pretty close. They sold this stuff and they rebought some other investments. So they probably borrowed to buy this, the majority of that equipment. They probably borrowed money to buy that. And we'll see that in the next section. Remember, we're in the investing section, so they had a negative number. You say, well, is that a good thing or a bad thing? Typically, if it's negative here, it's a good thing. If it's positive always, it's a bad thing because they're selling off assets and they're probably not doing anything to make their business more productive. So you got to be careful when you analyze this a little bit. But let's look at the next section. So financing is the last step that we're going to look at as far as the three major sections of the statement of cash flows. And it's really selling long-term assets. I mean, selling or issuing bonds or stocks or paying them off. And um, it also is dividends that the business pays to their common. And so that's what we're going to look at in financing activities. And we can look at the solutions that we had earlier, but what you had, it looks like they paid off notes payable. And really, you could look at a change in notes payable. Then they issued some more notes payable. So these are probably going to be in the notes that you saw. And then they sold some common stock and then they paid dividends. And that's all you're going to see here. So they borrowed some money, but it looks like really, if you go back and look at what they bought in the investing section, it looks like they pretty much paid for that out of current operations, because I think their cash flow from operations was 49,000. I think they paid 53,000 for that new piece of equipment. So what are we trying to do here? We're trying to figure out um, what really happened and what happened in the statement of cash flows. And you want to look at it really kind of on a year over year basis as well as against other companies. Because if you don't look at it year over year, and you don't look at it as against other companies, you don't have a perspective on what has really happened with the statement of cash flows for a business. And we want to take a look at different periods and what has happened and look at the different sections. And you'll notice here, for example, it says, as investments in property, plant, and equipment are likely to require several profitable years before the investment is completely recovered through the sale of goods and services, some managers will seek long term sources of cash, such as long term equity. So they don't want to always finance their long term assets with short term money within current earnings. They would rather borrow money longer term because that mitigates the risk of the organization. And and so they're going to use long-term cash inflows for operations for the and sale of long-term debt to do that. And and they can and basically what they're doing is they're growing their business. And you notice here on the bottom it says generally analysts believe cash flows from operations is the most important, which we touched on earlier, because in the long run this will be the company's source of cash used to provide a return to investors and creditors. Because if they don't have cash flow from operations long term, if it's not a sustainable business, they're not going to be able to pay you dividends, and that's not a good thing. Or they're not going to be able to pay back loans that they took out. So what do you want to look at? You want to look at it over several periods to understand what's going on, and you can look at a couple of different things. We're going to touch on free cash flow, and it's just simply free cash flow is net cash flow from operating activities, less capital expenditures, less cash dividends. That really tells you that they have other ways. This tells you that they have other ways or money that they can use to pursue profit generating activities. And but you notice here, you got to be careful because it could also be a negative number if they made some major investments in a given year. And you notice what it doesn't have here, but if they made investments, but they financed all those investments, the number could potentially be negative. So it's not always a bad thing. You have to really kind of look at it depending upon the company and the circumstances in the industry for which they're operating. And you look at similar companies to see what happens as well. This is kind of a cornerstone of financial analysis. If you're a finance major, always compare against other companies. And sometimes you might not be able to do a common size analysis, but you can understand what is happening with the financial statements of a business in the statement of cash flows by looking at businesses and saying, well, this particular type of business is investing and we're shrinking. So let's use a simple example that you guys might get. If you were to look at say for example J.C. Penney's or Sears, who are both retailers, versus the balance sheet or the statement of cash flow for TJ Maxx. Well, TJ Maxx and Ross and Marshalls are all, I think, under the same umbrella at Home Goods. Well, they're growing like crazy, but Sears and J.C. Penney are entrenching as well as Macy's. So they are not growing and they are selling off their assets. So if you were to look at the two different balance sheets or statement of cash flows, they would look vastly different because their business model is different. Even though they play in the same retail space, they're going to look different in their business model. So you might want to look at that base vis-a-vis maybe some stuff that you read in the popular press or what you really know about the business. Excuse me. That's the end of chapter 11. I will see you again in chapter 12. I hope you're having a good day and it's sunny where you are. Thanks.